Two crypto companies are now lending more to America than most countries. Last year, China's holdings of US government debt dropped below $760 billion, down from over $1 trillion just a few years earlier. You've probably seen the headlines. What you almost certainly haven't seen is who has been quietly filling that gap. It isn't another country. It isn't a sovereign wealth fund. It isn't BlackRock or Vanguard. It's two private crypto companies, one based in El Salvador, one listed in New York, that together hold close to $200 billion in United States Treasuries. One of them now holds more US debt than South Korea, more than the United Arab Emirates, more than Germany. This is one of the most important shifts in global finance happening right now, and almost nobody is talking about it. Today we're going to walk through exactly how this happened, who these companies are, where it leads, and what it means for your portfolio. This is Capital Unplugged. Stay tuned. Act 1. The numbers. Let's start with the scale because the numbers are genuinely surprising. Tether, the issuer of the USDT stablecoin, disclosed in late 2025 that its US Treasury holdings had reached approximately $135 billion. That makes Tether the 17th largest holder of US government debt in the world. Larger than South Korea, larger than the United Arab Emirates, just behind Brazil. Circle, the company behind USDC, holds another 45 to 55 billion. Combined with smaller players, the stablecoin sector is now the 18th largest external holder of US Treasuries, a category historically dominated by sovereign nations. The total stablecoin market sits at around $300 to $320 billion in market capitalization. Standard Chartered Bank projects this could reach $2 trillion by 2028, a nearly seven-fold increase. Their analysts estimate that growth alone would generate close to $1 trillion of fresh demand for short-term US Treasury bills over the next 2.5 years. This is no longer a crypto story. This is a US sovereign debt story. Act 2. Tether, the Libertarian outsider. To understand what's actually happening, you need to understand who these two companies are. They could not be more different. Start with Tether. Tether was founded in 2014, originally as a project called RealCoin, by a small group of crypto entrepreneurs who wanted to create a digital token pegged one-to-one to the US dollar. It was rebranded as Tether the same year and absorbed into the corporate structure of iFinex, the parent company of the crypto exchange Bitfinex. For most of its first decade, Tether operated from the British Virgin Islands. It was secretive. Its reserves were not properly audited. It was repeatedly accused of facilitating money laundering, sanctions evasion, and the so-called pig butchering scams that proliferated through Southeast Asian crypto markets. Critics called it the wildcat stablecoin. Regulators called it a problem. In January 2025, Tether announced it was relocating its global headquarters to El Salvador, its first ever physical head office. The company is now constructing a 70-story tower in San Salvador with a 30% tax waiver from President Nayib Bukele's government. Tether's official parent is now Tether Holdings El Salvador. The CEO is Paolo Ardoino, an Italian computer scientist born in 1984 who joined Bitfinex in 2014 as a software engineer, became Tether's chief technology officer in 2017, and was elevated to chief executive in December 2023. According to Forbes, Ardoino is now the 57th richest person in the world, with an estimated net worth of $38 billion as of April 2026. The largest shareholder is Giancarlo Devasini, Tether's co-founder and chief financial officer, a former plastic surgeon turned crypto entrepreneur, who is reported to hold between 40 and 47% of the company. Forbes valued his stake at over $22 billion in 2025. Now here's the kicker. Tether reported a record $13.7 billion in profit for 2024. Through the first 3 quarters of 2025, profit exceeded $10 billion more. The company has roughly 100 employees. Profit per employee is in a league with almost nothing else on Earth. In 2025, Tether was reportedly seeking to raise capital at a valuation of $500 billion, a figure that would place it among the most valuable private companies in the world. That money is being deployed aggressively. Investments in the video platform, Rumble. In Northern Data, an artificial intelligence infrastructure company. In BlackRock Neurotech. In Bitcoin mining infrastructure that Arduino claims will make Tether the largest Bitcoin miner on the planet by year-end. USDT itself is not officially available to U.S. residents, but in September 2025, Tether unveiled a U.S.-compliant stablecoin called USAT, run through a separate American entity led by Bo Hines, a 30-year-old former Yale football player whose previous job was at the White House, helping implement the Trump administration's crypto policy. Tether is the libertarian outsider that just walked into Washington's largest room. Act 3. Circle. The institutional insider Circle is the opposite story. Circle was founded in 2013 in Boston by Jeremy Allaire, a serial technology entrepreneur who had previously founded the video platform Brightcove, and his co-founder Sean Neville. The company is now headquartered in New York City. Its ethos, in Allaire's words, has been radical transparency and proactive engagement with regulators. Circle launched USDC in 2018 in partnership with Coinbase through a joint venture called the Center Consortium. The two companies dissolved that consortium in 2023, leaving Circle as the sole issuer of USDC. Circle attempted to go public in 2021 through a special purpose acquisition vehicle valued at $4.5 billion. That deal collapsed. 4 years later, on June 5, 2025, Circle finally listed on the New York Stock Exchange under the ticker CRCL at $31 per share. The reception was extraordinary. The stock closed its first day at over $82, a 167% gain in a single trading session. By late June 2025, it had hit an all-time high of nearly $299 before correcting heavily through 2026 amid broader crypto weakness. As of early 2026, Circle trades in the 100 to 130 range with a market capitalization around $25 to $32 billion. The financials tell a more grounded story than Tether's. Circle reported total revenue and reserve income of $2.7 billion for 2025, up 64% year-on-year. Adjusted EBITDA more than doubled to $582 million. The headline net loss of $70 million was almost entirely IPO-related stock compensation that has nothing to do with the underlying cash economics. USDC circulation reached around $75 to $80 billion by end of 2025, giving Circle roughly 25% of the global stablecoin market, a steady gain on Tether's still dominant 60% share. The partnerships read like a directory of Wall Street and Silicon Valley. BlackRock manages the cash component of USDC's reserves. Visa, MasterCard, Amazon Web Services, Goldman Sachs, and Deutsche Bank are all integrated with Circle's emerging Layer 1 blockchain, ARC, due for mainnet launch in 2026. The company received conditional approval from the U.S. Office of the Comptroller of the Currency to operate a national trust bank to oversee the USDC reserve. In late 2025, Circle bolstered its board with former Federal Reserve and Treasury officials. Allaire retains roughly 24% of the company's voting power. If Tether is the libertarian outsider that walked into Washington, Circle is the company that's been quietly building the institutional plumbing for years and is now collecting on it. Act 4. How we got here. The Genius Act. The catalyst that changed everything was a piece of legislation called the Genius Act, guiding and establishing national innovation for U.S. stablecoins. President Trump signed it into law on July 18, 2025. Paulo Arduino was at the ceremony. The Act's core provisions are straightforward. Every U.S.-issued stablecoin must be backed one-to-one by high-quality liquid assets. In practice, that means cash, short-term Treasury bills, repurchase agreements against treasuries, or government money market funds. Issuers must publish monthly reserve attestations. Annual independent audits are mandatory, and critically, payment stablecoins are explicitly defined as not securities and not commodities, removing the jurisdictional gray zone that had hampered institutional adoption for years. What this legislation accomplished, almost as a side effect, was to institutionalize stablecoins as a permanent, structural buyer of U.S. government debt. Every new dollar of regulated stablecoin issuance now legally must flow into Treasury bills or equivalents. Tether and Circle did not become major Treasury holders by accident. They are now required by law to be major Treasury holders, and the only direction that demand can go from here is up. Act 5. The story, the mainstream, is missing. Here's the part of this story that almost no one in the financial press has properly connected. In February 2026, Standard Chartered Bank's digital asset research team published a projection that should have made the front page of every business newspaper. Their analysis suggests that combined with anticipated Federal Reserve purchases, total new demand for short-term U.S. Treasury bills could hit roughly $2.2 trillion through 2028. Net new bill supply, if the Treasury maintains its current debt mix, would be only about $1.3 trillion. That's a potential shortfall of close to $900 billion. Standard Chartered's conclusion is striking. To balance the demand, the U.S. Treasury Department may need to ramp up Treasury bill issuance significantly, and could potentially suspend 30-year bond auctions altogether to redirect supply to the short end of the curve. Read that carefully. A major international bank is openly modeling a scenario where the structural shape of the U.S. Treasury yield curve is reorganized to accommodate stablecoin demand. The tail is wagging the dog. This sits alongside another shift that's been hiding in plain sight. China's holdings of U.S. Treasuries have fallen from over $1 trillion to roughly $756 billion. Most of the de-dollarization discourse on financial media has framed this as a structural challenge to the dollar. What that discourse has missed is that the gap is being filled, not by another sovereign, but by private dollar-pegged tokens issued out of El Salvador and Lower Manhattan. Dollar dominance is being maintained, but it's being maintained through a completely different mechanism than the one that has existed since Bretton Woods. No government chose this. No central bank designed it. It is, in a very real sense, the privatization of the dollar's reserve currency function. Act 6. The systemic risks. None of this is risk-free. There are 3 vectors of concern that serious analysts are now openly discussing. First, run risk. If a stablecoin issuer is unable to maintain its dollar peg during a stress event, heavy redemptions force the rapid liquidation of the underlying Treasury reserves. That isn't a theoretical risk. USDC briefly broke its peg in March 2023 during the Silicon Valley Bank collapse. A larger event could inject volatility directly into the Treasury market. Second, deposit flight from emerging markets. Standard Chartered estimates that banks across emerging economies could lose as much as $1 trillion in deposits to dollar-pegged stablecoins over the coming decade. Households in Argentina, Turkey, and Nigeria are already using stablecoins to bypass capital controls and to escape devaluing local currencies. The next front is Asia, Vietnam, Indonesia, the Philippines. When deposits flow out of local banks and into Tether or Circle, those banks lose the funding base they use for lending. The downstream effect is constrained credit creation in countries that can least afford it. Third, the loss of monetary sovereignty. The Bank for International Settlements, the European Central Bank, and the International Monetary Fund have all now publicly framed stablecoins as a systemic concern, not an investor protection concern. When a country's residents transact and save in dollar-denominated tokens issued by foreign private firms, the local central bank's traditional tools, the policy interest rate, lender of last resort capacity, foreign exchange reserves, lose their grip. This is being called digital dollarization. It is happening in real time, and it has no historical precedent. Act 7. The Investor. Angles for investors. 4 distinct angles emerge. The first is direct equity exposure. Circle trades publicly under the ticker CRCL. It is the cleanest, most regulated pure play. Coinbase, ticker COIN, earns a revenue share on USDC reserves and has substantial indirect exposure. PayPal, with its growing PYUSD stablecoin, is the dark horse. Tether itself remains private and outside U.S. jurisdiction, which is a significant part of its strategic positioning. The second is the rate market. Front-end Treasury bill scarcity affects everything from SOFR to repo rates to the broader yield curve shape. If Standard Chartered's scenario plays out and the Treasury Department restructures issuance toward the short end, the implications for fixed income strategy are substantial. The third is the bank deflation trade. Emerging market banks losing deposits at scale. Even developed market banks losing payment rail revenue. Payment processors, Visa, MasterCard, Adyen, are positioning to capture the new stablecoin settlement infrastructure rather than fight it. The traditional banking sector is being structurally squeezed, and it is not yet fully reflected in valuations. The fourth is the geopolitical hedge. Erosion of monetary sovereignty in non-US economies is accelerating the development of non-dollar stablecoins, central bank digital currencies, and alternative payment systems. The Euro stablecoin EURC is gaining traction under MyCA. China's digital yuan is expanding regional reach. Tokenized finance is becoming a new front in great power competition. The picture then is this: 2 private companies. One libertarian, secretive, mind-bogglingly profitable, headquartered next to a Pacific volcano. One transparent, regulated, blue-chip partnered, listed on the New York Stock Exchange. Together, they are now financing more U.S. government debt than most sovereign nations on Earth, and their growth is structurally locked in by federal law. This is one of the most consequential shifts in international finance in a generation. The mainstream financial press is still treating it as a crypto story. It is not. It is a sovereign debt story. It is a banking story. It is a monetary policy story. It is a geopolitical story. In the next episode, we look at another story the mainstream is missing: what the recent capture of Nicolas Maduro means for the world's largest untapped oil reserves and the investors quietly positioning ahead of the rest. If you want rigorous, ahead-of-the-curve coverage of the stories that move markets before everyone else catches on, subscribe to Capital Unplugged, and please note, this is not financial advice. Educational content only. Do your own research.